Yeah, you can make fun of me all you want, but I am rocking out. And there's a reason why I'm rocking out. But before all that, you hear the music and you see my face. But wait a second. Where's Dan Nathan? Well, we got a special episode of 1046, and I'll tell you why. I'm here today with the incomparable stud, legend, top of the Parthenon, the whole thing, chief technician from Cornerstone Macro, Carter Braxton-Worth. Today's episode of 1046 is brought to you by our presenting sponsors, FactSet, financial data and analytics powered by Tomorrow, and of course, our friends of Open Exchange. They manage virtual meetings that matter for the top companies around the world. We got a macro call, couple single stock calls, chart of the week, one for the road, and we got Carter Worth. How are you, my man? How are you?
How are you, my man? And thank you for having me. And
I am all, you can tell I'm all geeked up. Carter, you know,
well,
I mean, we've known each
hand,
other now. Go ahead.
I'm sitting here working hard. I'm in the office plugging away, but let's
do it.
Charts and have some fun.
Let's do it. I mean, look, it's obviously the macro call is the market. It's been an extraordinarily volatile week for markets. We saw it happen on Monday. We'll see what's happening today. I mean, it's pretty fascinating that these sell-offs in the market now are fewer and fewer in terms of the amount we have, and the duration seems to be less and less. I mean, this was effectively a one-day event. We have all these strategists calling for a correction: Morgan Stanley, Bank of America, BTIG, Fundstrat. We're going to take a look at a chart, but what are you seeing, CB Dubs?
Right. So, I mean, what we do know, if you get to the etymology of the word correction, and forget whether you call it dip or sell-off or drawdown or pullback or decline or correction, inherent in it is that there's something incorrect, right? If you extend yourself too far in the gym, you need to rest. If you stay in the library for 19 hours, your eyes get tired. You have to have breaks. And so implied in corrections or dips or drawdowns, they're good, not bad. And so the question is, this one is a 5%, right? We actually know, and we might have a chart here, that the drawdown from peak to trough so far is 5.28%. And the issue is, if you looked at this current dip, sell-off correction, in the context of all 5% plus corrections going back to the inception of the S&P in 1927, there are some statistics around these drawdowns, and this is a little shallower in terms of magnitude and duration than the median mean. So first of all, why 5%? If you lose 1% on a currency bet or a stock or an index, nobody cares, nobody's thinking about it. 3%, same thing. There's something that happens at 5%, whether it's the risk manager that comes in and says, listen, you gotta cut this back, or it's where people put in stop losses, or where the discomfort level starts to, whether institutional or retail. At the 5% level, if you looked at the following statistics, this is what there is. There have been 230 instances, 1927 to present, where the S&P has dropped 5% or more. And there is a lot of sort of similarity between the magnitude and the duration of those moves. So of the 230, right, and we have all the data from the start date to the end date, how long it took from peak to trough in terms of days, time elapsed till you recover and make a new high. And basically, the average drawdown of all 5% plus corrections is 11.9, and the median, which is more important, right, is 8.2. And the duration is about 27 sessions. So let's put that in context. This is 8.2% as a median, and we're down only 5.2. This has also been over 11 sessions. Typically, it takes 25. So this is particularly shallow, and we have now recovered the drop-in gap, which you can see on the chart there. And at this point, the odds are making a new high wouldn't happen at a minimum for 2 months.
So you're looking at a new high within the next 2 months. And just let me ask you a question, Carter, because it surprises me. Actually, I shouldn't be surprised anymore, but the duration is such that, we've become accustomed to a one-day sell-off, two-day sell-off event. And I think the market's become so complacent, realizing that, hey, you know what, this can be over in 3 or 4 days. I mean, am I making not enough of this, too much of this, or are we setting ourselves up for an extraordinarily large disappointment?
Well, that's just it. I mean, so if you get back to the etymology of the word, it's each correction is shallower and shallower, which means it's more and more uncorrected in its totality. Yes. Another way to look at this is, if you were to, and not depicted in this chart, but anyone who has a chart can look at it, is the duration of this move since we've actually gone back to a long-term moving average, whether you use the 200 or the 150-day moving average as I do. We're more than 12 months without having a sell-off dip correction decline back to the 150-day. There are only about 13, 14 instances in history where you've gone more than a year without a proper reset. And more often than not, they don't get solved by just a 5.2% sell-off.
No, exactly. And we'll see what happens if and when we trade back to that downtrend, that uptrend line that you drew. You know, that's a pretty steep uptrend line, obviously going back to the fall. I mean, we'll see what happens if and when we get to it. My sense is we will, and then that's the test, right? Do we fail at that uptrend line or do we break through it? I mean, and we'll talk about it if and when it gets there. So that's the broader market. And again, it is fascinating. It continues to befuddle me. I'm not really sure the etymology of that word, but it does it to me seemingly on an everyday basis. But first call we want to take a look at, and this is thanks for nothing. Raymond James downgrades Federal Express. And I'm not trying to get on Raymond James here because, quite frankly, a lot of analysts have had this wrong. I will tell you categorically that when the stock was trading 295 or thereabouts a few months ago, I power pitched this sucker on CNBC's Fast Money, thinking that it had a real chance to trade up to 380 just on valuation. But here we are after an extraordinarily disappointing earnings release a few days ago. And now you have a lot of analysts starting to take another look at FedEx. Talk to me about this downgrade, and then we're going to take a look at the chart.
Yeah, well, I mean, the thing about, as is always the case, big stocks like this typically are loved long term. So just to put this in context, we know there's about 30 plus analysts that cover the stock. And as is often the case, there's only one sell. Remember, in fact, of all ratings on Wall Street, only 5% are sell rated. There's a reason for that, because they don't want to offend the investment banking department and offend IR. And so what they do is they put it as a hold, right? Hold is a euphemism for sell on Wall Street. Wink, wink. We don't really like it, but we can't put sell. So 24 buys, 8 holds, which are sells effectively. And the price targets are all over the map. You've got big firms thinking it's worth 360, other firms saying 310, but they have the same spreadsheets, they have the same qualifications, they're all CFAs and CPAs and MBAs, and they do the same analysis, but they come up with completely different conclusions. But either way, I don't think you downgrade after the stock has just reported a miss like this. So let's look at a chart here. And look at this. This is a fantastic fact set. Look at this color scheme. So the yellow is price action, of course. The green are the volume bars. What I've tried to annotate here is, do you see how every 13 weeks you get a spike in the volume? Those are all quarterly beats or misses. The issue is that the street somehow can't get the earnings right at all. In order to gap down or up, have such a dislocation after earnings, it means that the consensus had to be so right or so wrong. And it's been so wrong over and over. Point being, we've dropped in gap twice here and 3 times out of the last 4. I don't think you downgraded here. In fact, I think you're contrarian and you make a bet that it's so bad it's good. In fact, look at this.
Yeah, listen, and I agree with that. We're going to look at another chart, but real quick, just to give you some indication, I just pulled a couple of analysts. And by the way, I could have done this probably twice as many as I did. But Susquehanna, they just remain neutral. Their price target is 280 from 307. JP Morgan, they took it off their focus list. Their price target goes to 329 from 346. UBS, $369 price target. That's lowered from 380. And Cowen, 297 from 335. The point is exactly what Carter just made. Analysts just can't get on the right side of this thing. The price target, I think, on average comes in around 315. I think CBW is spot on. They're late to this dance, and they should zig when they should zag. I think we want to take a look at transports now, CBW.
Yeah, and so what we know, and the FedEx here on the screen, is that you drop to that line. I think you hold here. You certainly don't downgrade it, right? If you're long, you suffer another day, and if you're contrarian, you make a bet that it's going to bounce. But transports overall, we know that the index, and there's a lot to Dow theory, but we know that the transports have been underperforming the market for about 5 months, right? They peaked about 5 months ago. But here's the thing. They were so far ahead of the market. In fact, this comparative chart, transports beating that. So think about that. You're talking about things that go plunk in the night, rails and boats and trucks, and beating the S&P. That yellow line has Amazon in it, and Facebook and Google, and it has tremendous other growth instruments. And the transports were so ahead of themselves, so ahead of the market, that this correction, this 4 or 5 months of malaise is welcomed. It removes some of the excess that we've seen in the index.
No question about it. And you're talking about not only FedEx and UPS, but you're also talking about the rails. And if you go back, not that we're going to look at these charts, but you go back and look at some of these railroads, all topped out a couple months ago. So CBW is right. They in the short term, they obviously a grim death. Longer term, there's still a lot to go in terms of the outperformance that we've seen. So I think this is a really great chart that illustrates it. By the way, it goes back to, I believe, 1979 or thereabouts, when Carter was just a young lad, as handsome as he is now, but a lot younger.
That's
Next
right.
thing we got to talk about is Plug Power CBW. And I'm glad you brought this to us. I actually like this upgrade. Piper Sandler, upgrade Plug Power. This bit of a hydrogen play, you can speak to it. The average price target on the street, I think, is $40.30. The range is somewhere between 13 and 78 in terms of analysts. This stock made an all-time high of about $75.49 back in February. So we've round-tripped that move. We will look at a chart. Speak to me about this. I know you have some thoughts.
Well, that's right. I mean, this is if you think about that, this stock was below $1 in the last 2 years. So when you compare this to a Peloton or a Zoom or any other high flyer that's had the same sequencing, a great run up and then a great collapse, this one supersedes all of them in terms of the magnitude of the run up and obviously the collapse. The thing is, this is where you do upgrade a stock
right
after a 75% sell-off and then this stabilizing and basing. It's a particularly good setup, I think, and the charts. Yeah, well, here we go. I mean, first of all, is it random? Is it a PE? Is it a price to sales level that it stopped at that purple line? Is that a PEG ratio? Is that a dividend discount? No, it's charts. Charts are important. People look at them. Algorithms look at them. It stops to the penny and bounces off the purple line. Now, if you look at the second Plug Power chart, this is a more immediate setup. We are into this wedge, and we are just now poking our head above the downward sloping line. So you have converging lines. You've worked into the apex. I think you go with this upgrade. I'm doing it technically, they're doing it fundamentally, but I think it makes sense.
Yeah, I do as well. I mean, you're in this little bit of a wedge. You have this, obviously, this long-term uptrend that we, believe it or not, I mean, we're still holding since the spring. That whole price action in January, February skews this thing a bit. But I got to tell you something, it definitely feels as though we're going to break out to the upside on this one. You've round-tripped the entire move. And I like an analyst that actually steps in at the right time instead of downgrading after the move is over. And I'm not trying to cast aspersions here. CBW, we have somebody named John Butters from FactSet does extraordinary work. He might be on the Parthenon with you. Please don't @ me at Twitter. One for the road today is the most loved sectors. I want you to speak to this. The analysts are most currently optimistic on energy, communication services, and tech, healthcare. A lot of things going on. I know you look at this almost on a daily, if not less than that, hourly basis. Speak to me about this. What does it say to you before we get on out of here?
Well, I think one thing about sector work, and it has to be said, is that the sectors, all of them are so concentrated, right? Let's take communications. It's not the AT&T and Verizon that it was. And when it was, they were literally the whole sector. And now, of course, with Google and Facebook and others, you're talking about just a handful of names that represent 40, 50% weight. It's the same in energy, right? Exxon and Chevron are half the weight. We know what it is in tech. And so while there is a lot of work done on the street about which sector one wants to be overweight and underweight, it really gets down to just a handful of names in each sector, just as Procter is 12, 14% of the staples sector versus Campbell Soup or Schmucker's Jelly. Yes. So anyway, I like consumer discretion. Staples, not so much. I think tech is just the long-term winner. But listen, one of my favorite areas is semis. I continue to like that a lot.
The semis are unbelievable, right? Led by a couple names in particular, AMD and NVIDIA. Obviously, there's some other names as well. You know what else I like a lot? I like you. And there's a chance that if I can read our thank yous, I can get out by 11 a.m. I want to thank our special guest today, the great Carter Braxton Worth, for joining us. I also want to thank our sponsors. Today's sponsors of 1046, brought to you by FactSet, financial data and analytics powered by Tomorrow, and of course, Open Exchange. They manage virtual meetings that matter for the top companies around the world. And a quick shout out to Mr. Michael Covino. His birthday today, I won't give you the number. He is at Open Exchange. Dan Nathan will be watching this on replay. CBW, you're a stud. Thank you, and thanks, folks, for joining us.
Cheers.